Welcome to this introductory lesson on Islamic finance, discussing its purpose, principles, and achievements. As usual, the learning materials for this topic can be found in the description below the video in order of appearance. Islamic finance developed in response to a widespread perception that conventional financial systems offer insufficient alignment with the ethical and legal requirements of the Sharia. The concerns expressed by scholars and practitioners prompted the creation of a distinct body of financial practices intended to mirror Islamic legal and moral imperatives more faithfully. In these series, we will examine the characteristics of Islamic finance, particularly Islamic banking, by outlining the central Sharia-based principles governing loans, risk-taking, insurance, short-term borrowing, and the broader acceptance of risk-heavy financial instruments. Across this discussion, it will be suggested that Islamic finance offers not only technical rules, but also a philosophical approach to economic life. While many of the ideals promoted by the Sharia are demanding in practice, they have attracted renewed attention, especially in the aftermath of the global financial crisis of 2007-08. Islamic finance encourages economic behavior that is mindful of social responsibility, transparency, and restraint. It is therefore unsurprising that several commentators view certain Islamic financial principles as potentially beneficial within Western Europe, particularly in limiting irresponsible short-term borrowing and constraining the influence of shareholders over corporate managers. Visser recognizes that at the same time, in practice, Islamic finance faces considerable challenges. Some of these arise from the realities of human behavior, specifically, the difficulties that creditors may encounter when dealing with borrowers under systems that prioritize lenience, shared risk, and moral responsibility. Islamic rules can also reduce the options available to modern consumers and businesses, making the system appear restrictive to those accustomed to the flexibility of conventional finance. Nonetheless, a growing body of opinion suggests that convergence between Islamic and conventional models may be desirable. Another possibility is that both systems could coexist within the same financial institution, offering clients, Muslim and non-Muslim alike, greater choice and giving regulators clearer insight into the operation of Islamic finance in Europe. As noted by Maududi, who is one of the most influential modern Islamic economic theorists, whose thoughts are aligned with those of the Wahhabite sect, Islamic finance is grounded in a series of prohibitions that govern the conduct of observant Muslims. These conservative views strongly shape contemporary understandings of Islamic economic ethics. Thus, practices categorized as haram, including the consumption of alcohol and pork, the involvement in adult entertainment, gambling, and, for many Muslims, the use of weaponry, are off limits. Financial activity is subject to the same overarching moral framework. The main objective of Islamic finance is therefore adherence to the rules laid down by the Sharia. Among the most significant requirements are the following. 1. The prohibition of riba. Extensive debate exists over whether riba corresponds precisely to modern Western interest. Nonetheless, most notable fuqaha, experts in Islamic jurisprudence, take the view that the two systems substantially overlap. Charging interest is therefore regarded as incompatible with Sharia-compliant finance. 2. The prohibition of maysir, speculation, and gharar, excessive uncertainty. Both terms carry connotations of deception, illusion, or impermissible risk. Gharar has particularly wide application in Islamic contract law. It requires first that the subject matter and price of a sale be known and ascertainable. Second, that the contracting parties be capable of fulfilling their obligations. And third, that crucial aspects of future delivery, such as quantity, quality, and timing, are clearly determined. The combined effect of maysir and gharar is that conventional insurance is not permissible. In systems based on premiums paid in advance of a claimable event, there is no guarantee that the insured will ever receive compensation. Islam takes the view that risk cannot be legitimately reduced by paying money ahead of time without a clear and guaranteed countervalue. For similar reasons, forward and future contracts are generally not accepted, except where they relate to agricultural commodities or fungible manufactured goods. As Visser notes, one underlying principle is that one cannot sell what one does not yet possess, as this undermines the certainty of future delivery. Sharia-compliant forward contracts, such as buy salam, prepaid purchase, Avoid this issue by requiring the entire price to be paid up front and ensuring that the buyer receives the goods at maturity. Another recurring feature of Islamic commercial law is that each transaction must be governed by a separate contract. Combined arrangements, such as a sale tied to a lease, must be executed independently. Islamic finance also emphasizes lenience toward debtors. The Quran instructs creditors to give additional time to borrowers experiencing genuine difficulty and even encourages the forgiveness of debts as an act of charity. This principle stands in contrast to many aspects of Western lending, where repayment obligations are often rigidly enforced. This flexibility is possible because, as El-Ashker and Wilson remark, Sharia is intended to govern all areas of a Muslim's life. This includes the economic sphere, where individuals are understood to act as God's stewards, Khalifa. Ownership is recognized, but it carries obligations, particularly those associated with fairness and social justice. Thus, contemporary Islamic finance is built around the principles of profit and loss sharing. Supporters of this model argue that Islamic finance affords a more equitable treatment of the poor, who are not subjected to the burdens of interest payments. Under a profit and loss arrangement, the outcome of the borrower's business has direct consequences for the Islamic financier. In contrast, under conventional lending, the bank receives interest regardless of whether the venture succeeds or fails. In contrast, Islam views fixed interest payments as unfair, since they allow lenders to profit without sharing in the risks of the venture. The moral dimension is significant. Imposing interest payments on the poor exacerbates their financial hardship and deepens inequality. The prohibition of interest also limits speculative behavior. Transactions not grounded in real assets, particularly those involving high levels of uncertainty, are discouraged. Islamic finance therefore resists the kinds of speculative activities that fuel economic volatility. This approach sounds attractive to many scholars, who argue that the erosion of moral financial principles played a key role in triggering the 2007 global financial crisis. In conclusion, Islamic finance offers a distinctive ethical and philosophical approach to economic life, built on the principles of shared risk, social responsibility, and strict adherence to Sharia prohibitions on interest, excessive uncertainty, and speculative activity. While its ideals present an attractive alternative to the vulnerabilities exposed by the 2007-08 financial crisis, Islamic finance remains challenging to implement fully in modern markets. Practical constraints, ranging from human behavior to regulatory complexity and consumer expectations, limit the scope of profit and loss sharing and other classical mechanisms. Nevertheless, the moral discipline and prudential safeguards embedded in Islamic financial doctrine retain clear contemporary relevance. The most promising path may lie in a model of convergence, or in the parallel operation of Islamic and conventional systems within single institutions, enabling greater choice for consumers and fostering a more inclusive and ethically informed financial environment. Thank you for your interest in this topic. We hope that this lesson was helpful to you and are looking forward to seeing you again soon.